Hello everyone, I am Dr. Anil Kolpe, Assistant Professor of Economics, Arihant College of Arts, Commerce and Science, Bhavdan Budruk, Pune. Today, we are going to discuss about the primary functions of private sector banks. First, introduction. The private sector banks are banks where greater part of the stake or equity are held by the private shareholders and not by government. After the nationalization, no banks were set up in the private sector. In the pre-reform period, there were only 24 banks in the private sector. The Narsimham Committee, in its first report, recommended the freedom of entry into the financial system. It stated that the Reserve Bank of India should permit the establishment of new banks in the private sector provided they conform to the minimum startup capital and other equipments. The committee also recommended that there should not be any difference in treatment between public and private sector and any restrictions in operation in this regard should be removed. The Reserve Bank of India guidelines on the entry of the new private sector banks observed that while the recognizing the importance and role of the public sector, there is a increasing recognition of the need to introduce the greater competition which can lead to higher productivity in efficiency of the banking system. Then next, the primary functions of private sector banks. The private sector banks play a very vital role in the Indian economy. They indirectly motivate the public sector banks by offering a healthy competition to them. The following are their important functions. First, A. Acceptance of deposits. It means the acceptance of deposit is the primary function of private sector banks, and in the under of acceptance of deposit, first is the time deposits. These are deposits repayable after a certain fixed period. These deposits are not withdrawable by check, draft, or by other means. It includes the following types. First, the fixed deposits. The, the deposits can be withdrawn only after the expiry of certain period, say 3 years, 5 years, or 10 years. The banker allows a higher rate of interest depending upon the amount and period of a time. Previously, the rates of interest payable on fixed deposits were determined by the Reserve Bank of India, and presently banks are permitted to offer interest as determined by each bank. However, banks are not permitted to offer different interest rates to different customers for the deposits of same maturity period except in the case of deposits of the 15 lakh and above. These days, the banks accept deposits even for 15 days or 1 month, etc. It means at times of the urgent need for money, the bank allows the premature closure of the fixed deposits by paying the interest at reduced rate. Then next, B. Recurring deposits. In recurring deposits, the customer opens an account and deposits a certain sum of money every month. After a certain period, say 1 year or 3 year or 5 year, the accumulated amount along with the interest is paid to the customer. It is very helpful to the middle and poor sections of the people. The interest paid on such deposits is generally on the cumulative basis. This deposit system is a useful mechanism for a regular savers of money. The next, cash certificates. The cash certificates are used to the public or a longer period of time. It attracts the people because its maturity value is in the multiples of the sum invested, and it is an attractive and high yielding investment for those who can keep the funds for a long time. It is a very useful account for meeting future financial requirements at the occasion of marriage, education of children, etc. And cash certificates are generally issued at discount of face value, and it means a cash certificate of the 1 lakh rupees payable after 10 year can be purchased now, say for the 20,000. Then second important function is that the demand deposits. These are the deposits which may be withdrawn by the depositors at any time without previous notice. It is withdraw able pay check draft, and it include the following functions. First is that the saving deposits. The saving deposits promotes thrift among people. The saving deposits can be held by the individuals and non-profit institutions. The rate of interest paid on the saving deposits is lower than the time deposits. The saving account holder gets the advantage of liquidity and small income in the form of interest. But there are some restrictions on withdrawals. Corporate bodies and business firms are not allowed to open SB accounts. Presently, interest on SB accounts is determined by the Reserve Bank of India, and it is 4.5% per annum, and cooperative banks are allowed to pay and the extra 0.5% on its saving bank deposits. Then B, current account deposits. These accounts are maintained by the people who need to have liquid balance. Current account offers a high liquidity. No interest is paid on current deposits, and there are no restrictions on the withdrawal from the current account. These accounts are generally in the case of business firms, institutions, and cooperative bodies. Nowadays, banks are designing and offering the various investment schemes for the deposits of money. These schemes vary from bank to bank. It may be stated that the banks are currently working out with the different innovative schemes for deposits. Such a deposits accounts offer better interest rate and at the same time withdrawable facility also. These schemes are mostly offered by foreign banks. In USA, current accounts are known as checking accounts, as a check is equivalent to check in America. Okay, then next next function is that the advancing of loans. It means that this particular function is a second function of the private sector bank in primary level. The commercial banks provide loans and advances in various forms. First is that the overdraft. This facility is given to holders to current accounts only, and this is an arrangement with the bankers. Thereby, the customer is allowed to draw money over and above the balance in his account. This facility of overdrawing his account is generally pre-arranged with the bank up to a certain limit. It is a short-term temporary fund facility from bank, and the bank will charge interest over the amount overdrawn. This facility is generally available to business firms and companies only. Then second function is that cash credit. Cash credit is a form of working capital credit given to the business firms. Under this arrangement, the customer opens an account and the sanction amount is credited with that account, and the customer can operate that account within the sanction limit as and when required. It is made against security of goods, personal security, etc. On the basis of operation, the period of credit facility may be extended further. Then one advantage under this method is that bank charges interest only on the amount utilized and not on total amount sanctioned or the credit to the account. Reserve Bank of India discourage this type of facility to business firms as it imposes an uncertainty on money supply. Hence, this method of the lending is slowly phased out from bank and replaced by loan accounts. Cash credit system is not in use in developed countries. Then third, discounting of bills. Discounting of bills may be another form of the bank credit. The bank may purchase inland and foreign bills before these are due, due for payment by the drawer debtors at discounted values, that is values a little lower than the face value. The bankers discounts in generally the interest on the full amount for the unexpired period of the bill. The banks reserve the right of debiting the accounts of the customers in case the bills are ultimately not paid, that is dishonored. The bill passes to the banker after endorsement. The discounting of bills by banks provide immediate finance to sellers of goods. It helps them to carry on their business. Banks can discount only genuinely commercial bills, that is those drawn against sale of goods on credit. Banks will not discount accommodation bills. Then fourth, loans and advances. It includes both demand and term loans, the direct loans and the advances given to all types of the customers, mainly to businessmen and investors against the personal security or goods of the movable or immovable in nature. The loan amount is paid in cash or by credit to customer account which the customer can draw at any time, and the interest is charged for the full amount whether he withdraws the money from his account or not. Short-term loans are granted to meet the working capital requirements, whereas long-term loans are granted to meet capital expenditure. And then previously the interest on the loan was also regulated by the Reserve Bank of India, and the currently banks can determine the rate themselves. Each bank is, however, required to fix a minimum rate known as the prime lending rate. It is called a PLR. Then next, the housing finance. Nowadays, the commercial banks are competing among themselves in the providing housing finance facility to their customers. It is mainly to increase the housing facility in the country. State Bank of India, Indian Bank, Canara Bank, Punjab National Bank has formed housing subsidiaries to provide the housing finance. The other banks are also providing housing finances to the public. But Government of India also encourages banks to provide the adequate housing finance. Borrowers to housing finance get tax exemption benefits on interest paid. And the further housing finance up to 5 lakh is treated as a priority sector advances for banks, and the limit has been raised to 10 lakh rupees per borrower in cities. The next, the educational loan scheme. The Reserve Bank of India from August 1999 introduced a new educational loan scheme for students of the full-time, graduate, postgraduate, professional courses in private professional colleges. Under the scheme, all public sector banks have been directed to provide the educational loan up to rupees 15 15,000 for free seat and the 50,000 for payment seat student at the interest not more than 12% per annum. This loan is on clean basis, that is without calling for security. This loan is available only for students whose annually family income does not exceed 1 lakh rupees. The loan has to be repaid together with interest within 5 years from the date of completion of the course. Studies in respect of the some following subjects which are the under this particular scheme. Then medical and dental courses, engineering courses, chemical technology, management courses like MBA, law studies, some computer science and applications degrees. And this apart, some of the banks have other educational loan schemes against the security, etc. But one can check up the details with the banks. Okay. Then the third primary function of the private sector banks is that the credit creation. Credit creation is one of the primary function of commercial banks. When a bank sanctions a loan to the customer, it does not give cash to him, but a deposit account is opened in his name and the account is credited to the amount is credited to his account. He can withdraw the money whenever he needs, but thus the whenever a bank sanctions a loan, it creates a deposit. In this way, the bank increases the money supply of the economy. Such functions are known as a credit creation. Okay, thank you. Thanks for watching my video.